is Elizabeth, and today I'm going to be analyzing 15 companies and determining which company I believe is the best to invest in. I'll be analyzing 3 industries: the retail industry, the fast food industry, and the gaming industry. I'll be using several different ratios to make my decision: short-term solvency ratios, long-term solvency ratios, asset management, profitability, and market value ratios to support my final decision. The first industry I'll be looking at is the retail industry. The companies I chose to look at were Macy's, Dillard's, JCPenney, Kohl's, and Sears. I chose Macy's as the best in this industry because they have the strongest potential for future growth. Their averages weren't always the highest, but they used their leverage to magnify their gains accordingly, and the gains came from operating margin, which to me is the strongest driver of profitability and the best indicator of potential future growth. The first thing I'll be looking at is short-term solvency. Here I made a graph of the averages across the industry. However, I don't think this is very useful because, as you can see here, JCPenney appears to have a high current ratio. However, if we actually look at the 5-year graph, we can see that JCPenney's current ratio has actually decreased over time. Here we can see that Macy's is right about second to last, so it's not especially good, but it's still over 1. I would expect retail industries to have higher current ratios because their inventory, most of their assets will be in inventory, which is included in the current ratio. The next ratio I will be looking at is the quick ratio. I would expect retail industries to have lower quick ratios because inventory isn't included in quick ratios. As we can see again, Macy's is in about the middle. Now all of the companies are on the decline, but Macy's decline is the least severe. Moving on to cash ratio, we see that the graph is kind of similar to the quick ratio before it, with all the companies being on the decline, but Macy's being the less severe and actually moving up in average from 2012 to 2013 to being the second best. Looking at long-term solvency, I'm going to be looking at 2 different ratios: their financial leverage and their cash coverage. Financial leverage tells us how much debt a company uses to finance its assets. Financial leverage can magnify gains, but it can also magnify losses. So it's important to look at the cash coverage ratio too, which tells us how many times over a company can pay off its interest. Now, looking at the industry averages, we see here that Kohl's appears to have the strongest cash coverage ratio, and Macy's appears to have the highest financial leverage. I'm not going to make this graph again because I only used it to show an example of how these industry averages, just using industry averages, can be deceiving. So when we look at the actual 5-year graph for financial leverage, we see here that Macy's has actually been on the decline, and Sears has been increasing sharply. Now, as I said, leverage is only good if you can actually afford it, and cash coverage gives us a better idea if a company can afford it. Looking here, we see here that Sears clearly cannot afford their leverage as they are in the negative cash coverage, which means they can't afford their interest at all. Macy's has been increasing their ability to pay off their interest, which is a positive sign, although Dillard's has the best incline. Moving on to asset management, specifically total asset turnover, which tells us how efficient a company is at generating revenue with the assets that it has. We can see that Macy's is actually at the bottom and Sears is at the top. However, total asset turnover is only one portion of profitability, and it takes everything in profitability to make a high return on equity. And later we'll see that if you have low everything else, total asset turnover can actually be a bad thing. A high total asset turnover can be a bad thing. So when we look at profitability, the most important thing that a potential investor would want to look at would be return on equity, because it shows us how much a company earns off of the money that shareholders invests. But return on equity has several components, and it's important to look at each one to see what's driving the numbers. Starting from the bottom, we see the profit margin is made of tax burden, interest burden, and operating margin. Operating margin is how much money a company keeps in earnings from its sales, but before it pays its interest and its tax. Operating margin is a good example of how well a company manages its costs. And it's the most reliable driver, I believe, in profit margin because it's the only one that managers can actually control. Tax and interest is kind of unpredictable from year to year, and it only drives operating margin up or down. Moving up, we see that when you take profit margin and you multiply it by the total asset turnover, you get your return on assets. Return on assets is how efficient a company is at generating earnings with the assets that it has back for its investors. When you multiply the return on assets by the financial leverage, you get your return on equity. If your financial leverage is bad, then it makes your return on assets worse. Now, if you don't have enough financial leverage, then you could be missing out on potential higher return on equity for your investors. So the first thing I'm going to look at is the historical analysis of profit margin. And we see here that Macy's started with a very bad one in 2009, but that is a great jump from 2009 to 2010. And then they are on the incline ever since. Looking at Sears, who had efficient total asset turnover, they have in the negative, as does JCPenney. Moving on to return on assets, we see that the graph looks kind of similar, which tells me that profit margin is the main driver of these numbers. We see here again that Macy's had great improvement, and about here they're about the third average at the best. Now when we move up here, we see that Macy's, for return on equity, has made a jump up here. That's because it was driven by its financial leverage, as I'll show later. Again, Sears is down here in the negative area because its leverage only magnified its losses. So when I look at the 2013 profit margin breakdown with all of the components, we can see here that Kohl's actually had the best profit margin because it had the best operating margin, although Macy's did have the second best. But Macy's didn't have the same interest burden as Kohl's. But to me, since interest burden isn't guaranteed, I think it's better to look at operating margin initially. Moving on from profit margin, we can see here that when Kohl's had the strongest profit margin, they did not have the strongest ROA. That went to Dillard's because they had a high total asset turnover. Here, Sears, if we remember, had a high total asset turnover. However, their negative profit margin was only made worse because of it. Moving on again to the return on equity, we see here that Macy's actually has the highest because they had about a mid-range, even though they had a mid-range to return on assets, they had high enough financial leverage which amplified their gains and brought their return on equity to be the highest. So it just goes to show how important it is to have a good balance of everything. And as we can see here, in the opposite, we see Sears' negative return on assets amplified by its large financial leverage gave it almost the worst return. The last thing I'll use to evaluate a company, the company standing, will be price to earnings, market value, and the first thing I'll be looking at is price to earnings. When we see here, I don't find this as useful as profitability because here the companies are all about the same. Now it's interesting to note that Sears had a very high price to earnings, which means right here that its investors had very high hopes for its future, but clearly their hopes fell. And then looking at economic value added, again we can see that Macy's has brought the most value to its company over the last year unexpectedly, which is why they are at the top and part of the reason why I chose them as the best company in the retail industry. Moving on to fast food, I chose McDonald's, Jack in the Box, Sonic, Wendy's, and Yum. Now the best in the industry, I chose McDonald's. They had the strongest profitability and the strongest return on assets. Now they didn't have the strongest return on equity, which is because they didn't use their financial leverage to their advantage. When compared to the rest of the companies, they're the only ones though with consistent financial strength, and they have no signs in decline in growth. Examining short-term solvency, we see here that McDonald's is about mid-range, and Wendy's is actually at the top. Moving on to quick ratio, that trend remains about the same here. Wendy's is at the top, McDonald's is mid-range, so maybe their strength isn't quite in liquidity. cash ratio again reflects McDonald's being consistently mid-range, with Wendy's having actually more growth. Moving on to long-term solvency, we can see, well actually it's difficult to see here, but McDonald's is at the very bottom because they have the least amount. Consistently though. Sonic actually had the highest number I've ever seen up here, but then they dropped it a lot. And now they're kind of lowering it out to match closer to the other companies. Now when we look at the cash coverage, we see McDonald's is much higher than everyone else. Probably because they don't have much debt, therefore they'd be able to afford their debt more because they don't have much of it. Sonic is down here, although it is to note that they had the most financial leverage, but they could still afford what they have. Now we move on to asset management. We see that, again, McDonald's is about midway, not quite the best. Yum is at the top, but again, you need a lot of different things to make up profitability. So when we move on to the profit margin, we can see McDonald's is a clear winner, being well above its competition in a range about, the 20, about 2019. And then the worst is Wendy's, even though they had the best liquidity. So you really need everything to be at the top. Moving on to return on assets, their strong profit margin led them to have strong return on assets, which is why they are again at the top. Now Wendy's has a strong return on assets probably because they had the strong total asset turnover, but again, it takes a lot. Now when we move on to return on equity, we can see here that McDonald's is again mid-range. Yum is at the top, but they are on a decline, and I wouldn't invest in a company that's been declining. McDonald's is the only one really that remains consistent when you look at the three that look fairly consistent. Moving on to the profit margin breakdown for 2013, we see here that the operating margin for McDonald's is way higher than the rest of its competition, almost not quite double of Yum, the second highest, so they are clearly doing something right when it comes to cost management. And then their high interest burden drove their profit margin up even further, but again, you can't really rely on interest burden. But considering that they had such high cash coverage, maybe it's not surprising that their interest burden would be so high. Moving on to the return on asset breakdown for 2013, we can see that again, the profit margin that McDonald's had drove its return on assets up. However, their lower total asset turnover didn't really help anything. Maybe if they actually had even brought it down, if it would have been higher than 1, say, it could have been much better. But having something below 1 didn't really help. Moving on to return on equity for 2013, we can see here that even though McDonald's had the highest return on assets, they didn't have the highest return on equity because they didn't have very high leverage at all. The highest return on equity actually goes to Sonic because they had the high leverage and about mid-range return on assets. However, again, I would still prefer to invest in a company that has its return on equity coming more from operating margin rather than its debt, because I think it's more secure. Looking at market value and price to earnings, we can see here that the four of these companies are really consistent, really around the same area, so it's kind of hard to make a decision based off of just this number alone. The only one being outstanding is Wendy's, but they're on a decline, so which means that their investors feel kind of negative about their growth, so you wouldn't invest in them anyway. And lastly, looking at economic value added, we can see here that McDonald's blows its competition out of the water as their number for their net operating after net operating earnings after taxes is much higher than everybody else's. Now, of course, their capital charge is also high, but they still have the highest economic value added. Moving on to the gaming industry, I chose MGM Resorts International, Isle of Capri Casinos, Boyd Gaming, Penn National Gaming, and Pinnacle Entertainment. Now, I chose MGM as the best in the industry. They weren't the strongest in a lot of different areas, but they had the strongest profitability. When looking at what's driving the profitability, it was operating margin, again, which I find the safest driver. Now, all of the casinos had negative incomes. They all had net losses. So it was kind of difficult to determine who was the best. And MGM had the least worst net income, so that was probably part of what made me choose them. When examining the short-term solvency, we can see here that MGM is about second in the current ratio, with Pinnacle doing this crazy zigzag thing. They obviously don't quite have consistent current ratios, which tells me that they're maybe not the strongest in liquidity if they can't keep anything consistent. And when we move on to the quick ratio, we see here that actually MGM is doing better than everybody else. And Pinnacle is down here, meaning that less of MGM's assets lie in inventory. And then when we look at the cash ratio, we can see again that MGM is at the top, although it is less than its quick ratio, but they have the most liquid assets to pay off their debt. Now when we look at the leverage, we can see here that Boyd has taken on more debt. MGM's has remained fairly consistent. It's increased a little bit over the past year, but not by much. And maybe this is good because maybe they're not taking on more debt than they can afford. We can see that from cash coverage though. And as we can see, they are having a hard time affording it as they are down here. Versus the Penn Gaming, which is all the way up here. Clearly they can afford their debt. Now looking at asset management, we see again, MGM is at the bottom. And Penn is at the top. However, these things don't do you any good if you can't generate the profits needed. Now when we look at profitability, we can see that all of the companies have had bad years since 2012. However, MGM is on the incline, as is Boyd, but MGM is recovering from better numbers. Looking on return on assets, it's almost the same exact chart because the trends are driven almost exclusively by profit margin. And again, when we look here, we see it almost the same thing. When we look at the profit margin breakdown for 2013, we can see that the operating margin was the clear driver for the profit margin. Although all the profit margins are negative, MGM's is the least worst. Moving on to return on assets, we see that again, they have the least bad return on assets. And actually having a low total asset turnover saved them from having a worse return on assets. And then finally, if we look at return on equity, we can see that there are a stronger ROA, but magnified by their leverage gave them a negative ROE, but they would have a negative ROE anyway because of the negative ROA. But still, had they had higher leverage like Boyd, then they would have had an even worse return on equity. I found that looking at market value, price to earnings for the casinos was not very helpful, as MGM didn't have any, and typically you don't have price to earnings unless you have positive net income. Looking at the economic value added was the most useful for the market value. And as we can see here, MGM does much better than the rest of the other companies in the most recent quarter. So after we've examined everything, my final decision as the best company of all 15 companies to invest in is Macy's. This is because they have the best potential future growth. They were the only company of the top 3 that effectively used leverage to magnify the gains. And the gains that they had were driven by operating margin, which indicates a good business strategy. It all goes to show that having the right balance between good profit and good leverage can lead to the best profitability. And that concludes my presentation.